Hey, what's up, everyone? Welcome to another episode of Tax Tip Tuesday, where every week we discuss real estate related tax tips, tax issues, tax strategies, anything tax related to real estate. And last week we discussed a cost segregation study, which applies specifically to rental property owners. Today we're going to discuss a topic that applies entirely to people who own their own property, who live in a property they own as opposed to renting. And in my opinion, this is one of the biggest tax loopholes or tax strategies out there. Not just real estate related, just any tax strategies. This is one of the best things for people to take advantage of in the entire tax code. And it is Internal Revenue Code 121, which is the capital gains exclusion. And basically what it does, it allows you to exclude a significant amount of gain when you sell your own personal residence as long as you meet certain qualifications. So let's dive into the specifics and discuss. All right, so let's look at the two big tax benefits when it comes to owning your own home. The first one is the potential for tax deductions. And you can potentially deduct your mortgage interest and your property taxes on your personal tax return. And I say potentially because whether you itemize or take the standard deduction depends on whether you can take that deduction or not. All right, so basically if you itemize, you can deduct those things. If you take the standard deduction, which many people do now, you cannot. But the potential is there to take those deductions, which is something that is not available to a renter. Right? If you rent your home, there is no way to deduct your rent. If you own your own home, you have the potential to deduct your mortgage interest and property taxes. And you can get really deep into the woods here, and we will get deep into those woods when we do a future episode specifically on that. All right, but that is one of the benefits. The second benefit, the main benefit in my opinion, and what I consider to be one of the best tax advantages in the entire tax code, is the capital gains exclusion. And this allows you to sell your personal residence and exclude up to $500,000 of that gain from your income. All right, so let's just say you sold stock and you made $500,000 on that stock sale. You're going to have to pay taxes on that $500,000. When it comes to your personal residence, if you meet certain requirements, which we'll go over in a second, you're going to be able to exclude potentially up to $500,000 and pay zero taxes on it. So it's a major, major tax advantage. All right, so let's look at the specifics here. The capital gains exclusion. It's the ability to exclude up to $250,000 if you are single or $500,000 if you're married of capital gains from the sale of your personal home. All right, so there's some rules here. The first big thing is you have to have lived in the home as your primary residence for at least 2 of the last 5 years. And the key there is it has to be your personal residence. If you have a vacation house in Florida, you sell it, that will not qualify unless it was your personal residence for at least 2 of the last 5 years. So there can be some strategy there, of course. If you have a vacation house in Florida you're planning to sell, go make it your primary residence for 2 years first, and then you can use that exclusion. Right? But it does have to meet that requirement with an exception that we'll talk about later. So then, to figure out the total capital gain, what you would traditionally be taxed on, you're going to take the sale price, what you sell your home for, and you're going to subtract it from the purchase price, the cost of improvements, meaning whatever you did to improve the home throughout the time you owned it, and the cost to sell. So what you paid to buy it, what you put into the house to improve it, and what you spent to sell it, which is typically going to be real estate commissions and closing costs and that kind of thing. So let's look at a specific example here. Let's say that you purchased a home for $200,000 in 2011. It was your primary home. You lived in it these last 12 years, whatever it is. You spent $50,000 improving that property over those 12 years. So you got a new kitchen, you got a new bathroom, you put a deck on the back. All in all, you spent $50,000 improving it. You sold the property earlier this year for $550,000. Right? The cost of your sale, meaning the real estate commissions and closing costs, were $10,000. So your total capital gains, to figure that out, you would take the sales price of $550,000, subtract the purchase price of $200,000, subtract the improvements you made of $50,000, and subtract the selling costs of $10,000, which means your total capital gain is $290,000. And again, if this were anything else, if this were a stock, if this were a rental property, anything like that, you would pay taxes on all $290,000. But because you met the requirements and lived there for at least 2 years of the last 5, if you're single, you're going to be taxed on $40,000 because you get to exclude $250,000. If you're married, you get taxed on nothing because you get to exclude up to $500,000. All right, so huge tax benefit. Basically, for most people, you can just take 15% of $250,000 if you're single, and that will be your savings. So over $25,000 tax savings if you're single. If you're married, over $30,000 tax savings. All right, so huge, in my opinion, one of the biggest tax code cheats almost that is out there. You can exclude significant amount of money and not pay taxes on something that you normally would have to pay taxes on. So what if you didn't live there for the full 2 years? What if you had to sell it a year after you bought it? Do you have any recourse here to take advantage of this? The answer is potentially. There is a partial exclusion. Right? If you don't live in the home for the full 2 years, you may be eligible to take a partial exclusion. So the first thing is the move has to have been made due to unforeseen change in circumstances. And some of the things that would qualify for this, you have a job change, and typically it has to be a change of at least 50 miles. Your new job's 50 miles away. You had a change in marital status. You got divorced. You had a change in health. So let's say that someone in your house had some type of health concern and had to start using a wheelchair, so you wanted a house that had better wheelchair access. That could qualify. Death of a spouse, birth of multiples, meaning twins, triplets, God forbid, more than that. For example, my wife and I in 2013, we were pregnant with twins and we sold our house because we wanted a bigger place. Luckily, we had already lived there 2 years, but if we hadn't, we would be eligible for a partial exclusion. All right, so here's how the partial exclusion works. You're going to divide the number of months you lived there by the full 24 months needed. So let's just say that you lived there for 12 months. All right, you divide that by 24 months and you would get half of that exclusion. Then multiply that by the exclusion you would have been eligible for the full amount. So if you're single, divide it by 250 or multiply by 250. If you're married, multiply it by 500,000. All right, so to look at an example here, let's say you're married. Let's say you lived in the house for 12 months. You had to move cross country for a new job. You could exclude a total of $250,000 of gain, right? Because you lived there for half the time required, so you could take half the $500,000 exclusion, which is $250,000. And that's obviously still a significant amount of money. A lot of people won't make over $250,000 on their gain. I used to think, back when I took the CPA exam in 2011, I used to think when I saw this, how could no one will ever make more than $500,000? So everyone will always get the full amount. That was in 2011, at the end of the Great Recession, when the housing market was still down. Obviously, we've rebounded significantly in the 12 years since then, and now some people are making 4, 5, 6, 7, 8 times that amount on a gain. Think of a person that bought a house in San Francisco in 1980. They could easily make a couple $1 million on the sale of that, and they could exclude up to $500,000 of that in that scenario. All right, so the conclusion: the ability to sell real estate with a gain as high as $500,000 completely tax-free is, in my opinion, one of the best wealth building strategies available to the average person. And there are cases, I've known someone personally in my old hometown who did this. They take full advantage of this by buying a new house literally every 2 years. Right? They move in, they fix it up while they're living in it. They stay there for 2 years, and then they sell it tax-free. And they do it over and over and over again, religiously moving every 2 years. Sometimes I feel like my wife's on this track. She seems to want to make us move every 2 to 3 years. But we're not doing it for that reason. Maybe we should start. But the strategy's there. Some people call it a live and flip. There's names for it. But all in all, again, this is a huge advantage to owning real estate. It's something that's not at all available to renters. It is something you can purposely take advantage of if you don't mind moving often. But even if you only use it once or twice in your lifetime, we could be talking tax savings of $25,000, $30,000, $50,000 if you do it 2 or 3 times in your life. So take advantage of it. Know what the rules are. Make sure you try to get to those 2 years if possible. Make sure you try to make it your primary residence if it's a vacation home, to take full advantage of it. But there it is. If you want any more information on this, feel free to reach out, comment below. Our contact information is right here. If you're looking to buy or sell a house and want advice on how to take advantage of this, feel free to reach out to us. Tune into future episodes. Next week, we're going to get back to the investing side of things and talk about depreciation recapture, one of the downsides of the tax advantages of real estate. But that's for next week. If you enjoyed this video, like and subscribe, and be ready for new ones.